Phil has been helping families in the Lowcountry area plan for a successful retirement. Phil at Revolutionary Financial Group will help you learn about strategies for creating income in retirement, managing your wealth, and minimizing taxes. Welcome to the Lowcountry Money Talk with Phil Bloyd.
Hi, I'm Jen Rezac, and welcome to Lowcountry Money Talk, the show that helps you plan the retirement you want. Today, Phil Bloyd from Revolutionary Financial Group joins me to talk about helping to preserve your income from some of the risks that you might not see coming. So, Phil, looking forward to the show today. Welcome once again.
Thanks, Jen.
So we're going to be talking about some of these risks, and the big question that we want to help answer today is your retirement able to resist a sneak attack? Now that sounds a bit ominous here.
Sneak attack. Well, I'm a Marine, so I'm ready
You're
for
familiar.
attacks. Yes.
Familiar with the sneak
Okay,
attacks.
so the things we want to look at is, as I mentioned in my book, I've retired 100 times. What's ahead of us? So being that I've worked in this industry for 32 years, I kind of have been through this hundreds of times.
Mm-hmm.
Right? So one thing, the first thing people have, am I going to have enough money?
Yeah.
The fear of outliving your income is a big one. It used to be one of the largest fears or the greatest fears that our retirees had.
Right.
The other one was public speaking. So when I'm out doing events, I say, we got two of those covered right now, two of the top two. So income, that's the first thing. A lot of people make an assumption that in retirement, they're going to need less income than when they were working. Well, in most of my clients' situations, I would say that's not exactly true.
Right.
Because what are we going to do when we retire? It costs money.
Mm-hmm.
We travel, costs money. Visit a lot. A lot of our folks here in the Lowcountry, especially in the summer when our special guests come in as tourists, they go visit their families.
Right.
So they're gone. So that costs a lot of money. So we tend to look at, okay, this is how much I was spending. This is about how much I'm going to need. We want to get an income plan together. We want to make some assumptions on our historical rates of returns. And the first thing we do is make sure we don't run out of money.
Right.
Now the challenge is ahead, a bear market. So if I'm too heavily invested in stocks, go back to 2008 for a minute, 50% downturn. To overcome a 50% downturn, it's about 100% return.
Right.
How long is that?
You got to do the math there, right?
Well, here's the problem people forget, Jen. They're not working anymore.
Yeah.
So if I'm working and I have that 401k and I have the dollar cost averaging, the market's going up and down, I'm buying some on a payday where the market's down, buying some when the pay. So it levels out.
Right.
And I'm always replacing, Once I retire, all my cookies are on the table.
Right.
I'm not going to get any more.
Right.
So those have to last. So that scares a lot of people. So the first thing we want to do is take a look at the income, and we want to make sure that we're not too aggressive. Because I always tell people it's easier if, let's say, for example, we're too conservative and we don't make enough return.
Mm-hmm.
Well, we didn't lose.
Right.
But if we're too aggressive and we lose a lot, it can take a lot more to make that up.
Yeah, and I think we should go back to what you said earlier about if you lose 50%, we have to make sure we understand the math there, because the temptation is to say, oh, well, I have to gain 50% back. But if you had $100,000, you lost 50%, that's $50,000. To get that $50,000 back, that's 100% gain. We lose sight of that, don't we?
Gonna take a while.
Yeah, gonna take a while.
And then we add in expenses and taxes and inflation and all this other stuff. I think one of the other big misconceptions that people have, Jen, is, I'm just gonna take $10,000 out of my IRA.
Right.
Well, 10,000 isn't 10,000. 10,000 plus whatever your tax
Don't forget Uncle Sam, right?
So maybe 10,000 looks more like 12,200. Mm-hmm. Okay, so we got to watch that stuff. Then we look at our expenses, and people are like, well, I have a person managing my money, and I'm like, okay, so let's see how much you're paying for your money management. Mm-hmm. Most people are unaware that they are paying so much to have their assets managed. So when I do a review for them and I say, okay, well, your advisor's charging you 1.5. You're in exchange traded funds or mutual funds, and the average cost there is another 1. So you're paying 2.5, and you think you're paying 1.5. maybe have some variable annuities or something. Those could be 3-4% internally.
Right.
So I'm like, well, right now you're paying about $25,000 a year to have your money managed. They're like, $25,000 a year. And I'm like, yeah, what if we could, slim that back a lot?
Yeah.
What would that look like?
Yeah. The other thing, when we talk about some of those percentages that sound kind of small, as you're saying, and when you talked earlier about people being worried about outliving their money, the reason why we're worried about that is we're living so long. You talk about those smaller percentages, but over the course of a 30-year retirement, that's really going to add up. So longevity is one of these sneak attacks we need to be prepared for.
So when are you going to die?
Don't know.
Well, if you drive on this highway outside the office here, it could be any day. I got news for you. It's really bad. So it's funny, though, that we have two different concepts there, or two ideologies. You may have one client come and say, well, I'm going to live to 95. And you have another one comes in, nobody in my family lives past 75. I'm going to die early. So I said, well, let's do this income review. And as long as we can stay in the green with some conservative return on investment, and you're in the 95 or so, and some are like, well, I'd like to see that go longer. I'm like, well, I've got like 5 clients past 95 now, out of like maybe 300 or something. So, probably that's going to do it. But, that's something to look at.
It's something you want to think about because, again, it sounds like a good thing to live a long time. It is a good thing to live a long time in retirement. We just want to recognize the financial side, which is being able to pay for taxes and income and vacations and all those things for a longer period of time. That's why we talk about it as a risk.
Sure. It's in some of my events, I ask people, if you were healthy and getting along well and enjoying life, how many of you would love to live to be 95? Let me see your hand. So they raise their hands. And I'm saying, okay, if you're broke, how many would, and then the hands don't go up. Right. So it's not as fun to live and outlive your income, so it takes some of the joy out of things. So that's some of the things that we want to talk about. We want to be honest with people. It depends a lot on how you have your money arranged. A lot of people, when they come to me, they're way overly aggressive. And I said, it's good that you're optimistic like that, but maybe we need to retool that a little bit, use that rule of 100. Everybody beats up on that rule until we're in like the market we had last year. Right. Then they're like, oh yeah, that's pretty good. I like that. Yeah.
Right. We want to be making informed decisions and we want to be thinking about things like longevity and potential market volatility, tax increases. You and your team, you spend a lot of time talking to people and you put together plans that really address all those different areas. Yeah. So just a lot that we want to be thinking about, a lot to cover here. It's so important to have a handle on some of these risks that you just might not see coming. That's why we're talking about this on the show today. So you'll want to stay with us. When we come back, Phil will talk about another culprit that could be launching a sneak attack on your retirement. Stay tuned. We'll be back.
Did you know taxes could be your biggest expense in retirement? No one can avoid taxes completely, but with the right strategies in place, you could potentially reduce your taxes in retirement. With a plan to protect your retirement savings from higher taxes, that's just more of your hard-earned money back in your pocket. And at Revolutionary Financial Group, helping people like you minimize your taxes in retirement is what we do. Call us today to learn ways to possibly lower your taxes in the future. Saving is a really good start when it comes to retirement, but you have to do more than just save. You have to think about income in retirement. When it comes to your retirement, do you really want to pay bills with guaranteed income or just maybe income? Hi, I'm Phil Bloyd with Revolutionary Financial Group. Our team creates comprehensive plans for maximizing income and minimizing taxes for families right here in the Lowcountry. Call today to book your free 15-minute consultation.
Welcome back to Lowcountry Money Talk. I am Jen Rezac, and we're here today with Phil Bloyd of Revolutionary Financial Group, talking about these sneak attacks on our retirements. And we've talked a little bit about the impact of longevity and how some of those things can impact our retirement without us being aware of it. Another risk is inflation. Now, we used to talk about this as a sneak attack, but it's kind of been front and center for us for a while now.
Jen, we started at 9 Was it 9.4% last summer?
Yeah, that's
And
crazy.
everybody was freaking out. I mean, that's 40-year higher. So, I mean, I don't remember that. It's been so long.
Yeah.
Now I think it's like 4 something, but also the cost of living. I mean, everything costs more. Gas is way up. All these things are up more. So where are we going to get the funds to pay for this if we're retired?
Right.
Our Social Security went up 9%, but everything else went up more. So it's like, well, you know, what are we going to do? Well, most people, they jump into that middle IRA bucket and they're like, well, I'm just going to take more money out of my IRA.
Right.
And I'm like, well, the double-edged sword was your IRA wasn't invested properly. So you had too much in the stock market that was in your IRA. So now your IRA is down 20%, and then you're going to take more out of it because of inflation. So you're going to pay more in taxes. You're selling low. We don't want to sell in a low stock market. So when the market recovers, the money's not going to be there to come back up. So, you know, we talked about earlier how, you know, if you lose 50%, you're going to have to get 100%. Well, if you withdraw money out of that, you're going to have to make even more than 100%. And let's say you're 75 years old, longevity. How long do you have to recover? The one thing I always like to do is I like to set aside 2 IRAs. I call it the bull and bear IRA strategy. And I do go over this in my book. Okay. So the bull IRA would be designed to be in a more of a bull market strategy. So the market's growing, it's more in growth stocks and things of this nature. So if the market's affected, it goes down 20%, I'm going to stop my withdrawals from that bull IRA. I'm not taking any more out of there because I don't want to sell low. That's breaking a rule. We're supposed to buy low and sell high,
right.
But everybody does the opposite because fear and greed move the market, right? So everybody gets scared when the market dumps and they sell everything low. So don't want to be pushed into that corner. So our bear IRA would have the characteristics that when the market goes down, it doesn't move much at all. So, you know, the IRS doesn't care which, you can have more than one IRA. And you can combine all the values of all the IRAs for your minimum distribution, but take it out of just one. So the idea is when we're in a bear market, guess where we're going to take our money? From the bear market IRA, right? Because this didn't go down in value. So at worst, let's say it's evened out and it's just not going anywhere. Last I checked, 0 is better than a -20. Okay.
Yeah.
I always like to help people with the hard ones. But, you know, we want to have that bull bear IRA strategy in the inflation era and the downturn in the market. Because last year we got hit with a double whammy for retirees, a down market and high inflation both.
Right.
Yeah.
Right.
So luckily we did have lower taxes though because of the current tax code.
Which again, clock is
helps.
ticking on that. But
Tick tock.
you know, with inflation during our working years, a lot of times we'll get pay raises throughout our career, and that kind of offsets as things cost more. We tend to make more. How do we potentially build in pay raises for ourselves as we go through retirement? Because the same cost increases will continue throughout a 30-year retirement,
Sure.
right?
The 2 easiest things I think, Jen, one, let's look at that tax return.
Okay.
Let's see where we're taking our income and let's see if we can make some changes there. Maybe you're taking too much out of the IRA bucket. Maybe and we recommend in an emergency fund no more than 6 months expenses. So if your expenses are $5,000 a month, why do you have $250,000 in your checking account to look at? Okay.
Right.
So all of these areas, one, that can help us through that, making sure we have the right funds in the right buckets. And the other thing is we want to look at the fees and expenses we're paying to manage our money. Most of the time we're going to find savings in those 2 areas. I would start there.
All right, that's kind of the low-hanging fruit. But again, there's so many different components that we want to be thinking about when we talk about things that can take us by surprise in retirement. Let's go ahead and talk about taxes for a moment. I don't know if it's a sneak attack because we talk about it all the time, but I'm guessing there are people who are a little surprised or a little stunned by what their tax liabilities are.
Well, they've been told their whole lives, Jen, that, hey, when I hit retirement, I'm going to be in a lower tax bracket.
Right.
Doesn't happen. You lost all your deductions. Those kids that eat a lot, they're gone. You don't get a deduction. That was not really a good deduction anyway because you spent way more, I don't think. You know, those kids are expensive. But that, you know, their mortgages are paid for. So they don't have any mortgage interest to deduct. So there's a lot of things, you know, that they thought, they're like, oh, well. And they end up in the kind of the same tax bracket they were in before. And they were told, hey, when you retire, you'll be a lower bracket. Not so.
Right.
Costs a lot to live these days.
Yeah. Are there strategies where we can potentially, we've talked before about those tax deferred accounts where maybe we set up our retirement savings so we'll pay the taxes later. What kind of moves could we make if we say, hey, maybe I want to go ahead and pay the taxes now, get it over with, and then enjoy that tax-free income later?
Sure.
Is that an option?
What I always tell people is, hey, let's say I own a business and I got a lousy partner. And I know as soon as I get rid of this partner, my business is going to go through the roof. Well, the thing I have to do to get rid of that partner is I got to buy them out. Would I rather buy them out while the value of the business is low or wait for it to get higher? The same with your taxes, okay? So we know what the values of the taxes are now, okay, because the values of the IRA accounts. We also know what tax rates we have now. After 2025, we don't really know. We know it's going to go up more than likely. So it's like, let's get rid of that partner in the IRS now, and let's buy that partner out as best we can now while the rates are lower.
Right. So one of those options we can learn about. And it's just important that we get that second opinion before we try to make any financial decisions. I'm guessing any move like that, we want to get some guidance first from somebody who spends a lot of time helping people plan for retirement.
Well, what we do first is we're going to bring in your tax advisor.
Yeah.
And we're going to say, give us some sample runs on what our taxes would look like if we converted $50,000 this year of our IRA to a Roth 75, 100. So we want to get them involved as part of the team.
Right. A lot of different sneak attacks, and that's why your team puts together these plans for people preparing for retirement that do cover things like your income, your taxes, healthcare, long-term care, all of those different issues. We have to prepare for those as we're getting ready to retire, right?
Right. You're going to be dealing with them sooner or later.
Right.
We'll deal with. When I do a plan, I look at the beginning, but also look at the end from the beginning because I've done it so many times.
Okay.
So this year only, if you do it well, you retire once, right?
Right.
So I've already been through this many times. So I'm going to take all of what potentially could happen and did happen to clients years ago, and I'm going to apply that to the plan we put together.
Yeah, you've walked people through this. The title of your book says it all, right?
Right.
Absolutely. Well, here's how you can contact Phil and the team at Revolutionary Financial Group. When we come back, though, Phil will answer some of your questions, so stay with us. We'll be back.
Hi, I'm Phil Bloyd with Revolutionary Financial Group. Over the last 32 years in the financial industry, I've seen about everything. There's so much I'd like to share with you about the benefits of solid planning and the pitfalls that can derail your retirement. I'd love to send you a copy of my book. I've retired hundreds of times. You'll learn more about tax and income planning and more. Remember, at Revolutionary Financial Group, there's more to your retirement than just your money. Saving is a really good start when it comes to retirement, but you have to do more than just save. You have to think about income in retirement. When it comes to your retirement, do you really want to pay bills with guaranteed income or just maybe income? Hi, I'm Phil Bloyd with Revolutionary Financial Group. Our team creates comprehensive plans for maximizing income and minimizing taxes for families right here in the Lowcountry. Call today to book your free 15-minute consultation. Did you know taxes could be your biggest expense in retirement? No one can avoid taxes completely, but with the right strategies in place, you could potentially reduce your taxes in retirement. With a plan to protect your retirement savings from higher taxes, that's just more of your hard-earned money back in your pocket. And at Revolutionary Financial Group, helping people like you minimize your taxes in retirement is what we do. Call us today to learn ways to possibly lower your taxes in the future.
Welcome back to Lowcountry Money Talk. I am Jen Rezac here today with Phil Bloyd of Revolutionary Financial Group, and now it's time to hear from you. So, you ready to answer some viewer questions?
Ready,
all right.
Jen.
I know we always enjoy this part of the show.
I do.
All right. Our first question comes from Marie in Hilton Head, and she asks, can you explain the term rebalancing? I keep seeing this in retirement planning articles, and I don't think I really understand what it is.
Sure.
So, rebalancing.
What I would think we're talking about here is like the rebalancing of your portfolio. So let's say that the tech sector, which is happening a few months back or whatever, a few weeks. So let's say it's growing faster than maybe another sector in your portfolio. And you want to be equally balanced in all different sectors. You want growth, you may have some income or some different things. So what happens is if one sector tends to do a lot better than another, you'll get out of balance, kind of like your washing machine gets out of balance. So you want to keep that in balance. So usually quarterly, a lot of portfolio managers will rebalance that portfolio to get the right percentages in the right sectors or so. So that's what she's talking about.
Okay,
Yeah.
so one of those, I guess it means we don't want to set it and forget it when it comes to our money, our investments,
You
that
want to
type
keep
of thing.
kind of balanced.
Yeah.
So you're going to want to keep, well, because let's say, for instance, last year the tech sector did really, it was down 35%. Well, that same sector's up 35% this year. So you don't want to be totally out of a sector, especially if you have passively managed money. You know, so you want to be kind of balanced just because that one sector might pop and then you're not in there.
All right, great question there. Next question, Jim in Sun City says, how much communication should I be having with my financial advisor? I only talk to him if I reach out to him with a question, and that rarely happens. So how much interaction should there be?
Well, Jim must be pretty happy because he doesn't have too many questions. Well, it's different for every person. I'll have some clients that want to talk quarterly. I'll have some clients that pay really close attention to all their statements, or they're following their online account and they already know. So they're like, well, I've been following you. I don't really need any. I know what's going on. So it's just an individual thing. But that's something that you and your advisor should talk about. Don't be shy. So if you want more contact, just tell them, hey, I'd like to come in and see you quarterly, or I don't want to see you for once a year or whatever. But
Right.
a lot of that could be on Jim. You need to let them know. A lot of times I tell clients, Jen, you know, the question I can't answer is the one that's in your mind but doesn't come out your mouth. You know,
You haven't perfected mind
not
reading
yet. I'm working on it.
Not yet.
Not
Well,
yet.
I think the big idea there is when someone retires, it's not as if you send them into a 30-year retirement and wish them well and
Right.
that's it. There will continue to be some sort of
Sure.
back and forth because life changes happen, right? I mean, there's marriage, there's death, there's divorce. Talk about some of the changes that might need to be communicated to your advisor as
Sure.
life goes on.
Well, the biggest change will be death,
yeah.
because then you have a surviving spouse, so the income needs may be different. They usually are. So there's a lot of changes that go in there. If, for instance, let's say that we have health issues and dementia, or you know, that's also a huge change. So we need to definitely look at things in that
Right.
area. Unfortunately, it happens way too much, and a lot of times, you know, me and the team will be the first ones to notice. You know, if let's say you're a widow and you know your kids, and I'm like, hey, do you mind if I talk to your child a bit? You know, I think we got some issues here we need to talk about. So yeah, those things, but a good investment advisor will know a lot about that person, maybe even more so than some of their relatives.
Yeah. Good questions to ask there. Here's a question from Gary in Bluffton. I'm 62 years old. My wife wants me to retire and start collecting Social Security, but I'm not ready to retire, and I honestly don't think we have enough money saved up. So what's your recommendation on how we should go about this?
You better do what your wife says. That's what I would say. You
Good
know,
rule of thumb.
if you want to make your life happy, do what your wife says. I've been married 35 years, only to 7 women. No, just one actually. But you know, he does have some 62. So let's see. Are you going to retire and start taking Social Security at 62? Are you going to retire and take money from your investments and wait till your full retirement age? Are you going to partially retire at 62? Then there's some earning limits on your Social Security if you were to take it. There's a whole lot of things. It sounds like a very simple question, but it can be very complex.
Right.
Depending on the details. So the one thing I'm a little concerned about is everybody, you know, where they retire at, say, early at 62, and they're like, well, I'm not taking my Social Security yet. I'm going to wait until I'm full retirement age, which may be 67. And I'm like, okay, that's great. How long are you going to live to?
Don't know.
Okay,
Don't have that
so
crystal
if you
ball.
wait till you're early 60, you may not even live to 67, first
Yeah.
of all. So that was a bad deal. And they're like, well, I'm going to take it at 70. I said, okay, how many people in this room are over 70 now? couple hands go up. I'm like, okay, so how many of you know you're going to live to be 70? Just the hands that went up. So that could be a flaw in your planning strategy on taking Social Security. We have to be careful. But the thing I don't like is to retire, put off my Social Security, and then take money out of my IRA, which is taxable, to supplement my income because I'm waiting on my Social Security. And then if you and your spouse both pass away, how much of your Social Security will go to your children?
Oh, Social Security is none, right?
Okay, but if I'm taking my Social Security and delayed taking out of my IRAs and we both die, then how much of that money would go to my children? Whatever's left.
Right.
So, these are all things to take in consideration.
Yeah.
And usually I have people do a little math quiz, and it'll be like, okay, if I take at 62 and the difference in what I would get at 67, how many years would it take for me to catch up? Usually it's about 12 to 14 years. So you would have to be at least 74 to 76 to break even. And are you sure you're going to be around? Again, traffic's bad these days.
Yeah.
So, I mean, I don't know.
There's just a lot we
There's
don't
a
know.
lot.
There's a lot of
A lot
variables.
to think about, yeah.
All right. Here's a question from Donna in Sun City, who says, now that I'm 73, I have to start taking RMDs. What do I need to know before I start taking this money from my retirement accounts? So let's explain what an RMD is.
Required minimum distribution. The good news is if you miss it, okay, and it's required. So if you miss it, there's a penalty.
Right.
Used to be 50%, now it's 25%. So that's better.
A little better.
A little better. But if you miss it, you only do it once, because then you'll put a note on your refrigerator for like 20 years. It says, do not forget to take my required minimum distribution, okay? We're going to help you with that. So we don't want you to miss that. So we send out letters and reminding and everything. So the rules have changed with the Secure Act and all these things. So now the age is 73. So April 1st, following my 73rd birthday, I have to take a distribution. But we have to be careful on when our birthday falls, or we could that first year have to take 2 full distributions.
Oh, gosh.
So it's a little complex. I always tell people, let's just take one when we're 73 and then we'll just go forward. The thing that people need to understand is if we look at the tables where they figure out how much you have to take out, they make you take more of a percentage out each year because they want those funds taxed. So eventually those accounts are designed to deplete.
Wow.
Yeah.
Yeah. Again, there's a lot of rules and there's penalties if we don't follow the rules.
Right.
So it's important to get that guidance.
One-time penalty.
That's right. Oh,
then you
my
get
goodness.
the note.
Oh, my goodness. Well, if you have a question, you can visit the website or call the number on your screen. What you've heard today is just information unless you actually take action. So why wait? Call now. And we hope to see you again next week. For Phil Bloyd and the team at Revolutionary Financial Group, I'm Jen Rezac. Have a great day and an even better retirement.